For most business owners, June is a nightmare. They're digging through receipts, chasing the accountant, trying to work out how much tax they owe and where the money's going to come from to pay for it. And then you've got clients that go through June and barely notice it. There's nothing to chase, no surprise bill, and no scramble because the work was already done. I've been doing this for 13 years now, and after a few hundred business owners, I can tell you the difference between those two groups has almost nothing to do with what they do in June. It comes down to what they were doing for the 11 months before it. So I want to show you exactly what that looks like, where the stressed ones go wrong, and the mistakes I watch people make every single year that costs them real money and in a couple of cases nearly costs them everything. The first thing to understand is that nobody actually gets stressed about tax planning. They get stressed when they realize they never did any, because the planning itself isn't the hard part. The hard part is the moment the accountant finishes the work, hands it over to you, the business owner, and you look at it and you say, hang on, where did all the profit go? I can't believe we made that much, and I definitely don't have the cash sitting here to pay this tax bill. I met a guy who booked a call off one of these videos, and his accountant was right then doing his 2025 tax return, which had actually been due 11 days earlier. So whatever the bill turns out to be, it's already late and the interest is already accruing. And he's got no idea what the number even is. That's the spot a lot of owners are in, because tax is one of the biggest expenses you'll ever have, bigger than most things in the business. And yet people go a whole year with no clue what it's going to be until it's sitting right in front of them. By the time you're feeling it in June, your options have mostly gone. So that panic isn't really a June problem. It's 11 months of not looking at it, all landing on you at once. Now, once people feel that panic, the instinct is always the same. They want to know what they can buy or spend before 30 June to make the bill smaller. And I get it. But I have to be honest with people about how little that actually does, because the only real way to reduce your tax is to reduce your income. And by June, it's far too late to do anything about that. So people land on buying equipment, and even that has a catch because the gear has to be installed, ready for use before year end. You can order it and pay for it and have the invoice, but if it's not actually installed and running, you don't get the deduction anyway. And even when it does work, look at the maths on it. You spend $100,000 on a piece of equipment to save $25,000 in tax. If you genuinely need that equipment, sure, go ahead and buy it because that's just a good business decision. But buying it just to dodge tax means you've spent $1 to save 25 cents, and that's madness. I'd much rather a client just maximize their profit and pay the tax on it, because honestly, the stuff that reduces tax just isn't the big lever everyone thinks it is. And the rushed version of this is where it actually starts costing people. I had a client sell some shares, made a big capital gain, and he thought he'd held them for a year, and so he'd get the 50% discount. He was one day early. He sold on day 365 instead of waiting another 24 hours. And that one cost him the entire discount on the sale. That's what reactive decisions in June look like when you're so focused on the deadline. So if June panic is the symptom, the question is, what are the calm business owners doing differently? And it's simpler than people expect. They run their year in 4 90-day sprints. Each quarter, they set a profit target. They put their energy into the things that actually bring money in and hit that target. And then they move on to the next one. 4 good quarters make a good year. You can even have 3 good quarters, have 1 ordinary one, and still come out fine. The reason that works is that profit and cash flow are tied together. When you're making good profit each quarter, you've got good cash flow. And when you're paying the tax as you go, it never gets a chance to snowball into one big, terrifying number at the end of the year. It's actually what I do myself. I just get our bookkeeper, Tracy, to work out the tax and pay it each quarter. And we pretty much always end up with a small refund at tax time because we've stayed in front of it. I'm working with a guy in construction right now who shows both sides of this. When he came to us, he was the textbook stressed out version, never looked at his numbers, no idea how much he was making, let alone how much tax he owed on it. His old accountant finished off the prior year and handed him an enormous tax bill he wasn't even expecting. And I actually had to go back to that accountant and very politely ask them to adjust a couple of things just to bring it down. The stress on him and his wife through that period was immense. Now we meet him every quarter and plan the tax every quarter. So he's paying enough as he goes. Yes, you're prepaying tax rather than holding on to the cash. But a steady quarterly payment beats a massive lump sum coming down the track every time. There's one more thing the good ones get right, and it's how much they pull out of the business. A company only pays 25% tax, which is low. But the moment you pull the profit out into your hands, you're paying the higher personal tax rates on it. And you end up strangling the business for cash flow on top of it. I've actually got a client at the moment who's had an incredible year, and I'm trying to encourage them to take a bit more out of the business because they've been a bit conservative. Most people have the complete opposite problem. Super works the same way once you stop treating it as a year-end job. Most owners are scrambling to get their super paid before 30 June, but if you pay it every pay run instead of saving up for the end of the quarter, there's no scrambling over it because you're always in front. By the time June rolls around, you've already paid April, May, and June as you went. So the deductions are already brought forward and there's nothing left to rush. And from 1 July 2026, it's going to be mandatory to pay super every pay run anyway, so you may as well get it set up now. So far, everything I've talked about is about cash flow and not getting surprised. But there's a different category of end of financial year problems that's far more dangerous because it has nothing to do with how much tax you pay. It's about whether your documentation is actually in place before 30 June. And most business owners never actually think about this until it's too late. Here's where it bites. If you run a family trust, you have to do your trust distribution resolutions before 30 June, which means documenting who the trust income is being distributed to for the year. A lot of accountants still don't actually do this properly. They leave it until when they do the tax work months later. If you pay dividends out of a company, it's the same deal. The ATO says a private company has to declare and document that dividend to shareholders within 4 months of the end of the income year. And the dividend resolution itself must be done before 30 June. And if you're distributing to a bucket company to get the lower tax rate, you've got the 45-day holding rule to deal with on top of all this, which governs whether you can actually claim the franking credits. Now, people think they can just create these documents later and then backdate them. And here's why that does not work anymore. There was a case recently where the ATO called on the electronic documents, as in the actual Word files, because when you create a document on a computer, the file records when it was made. So if the resolution says 30 June, but the file was created in October, the court can see straight through this. And you can't prove you did it on time. That's what's happening right now. So people are failing audits purely on documentation, not on the tax itself. A case came out recently that shows you exactly how far this can go. A family running a bus services business got hit with a combined tax and interest bill of over $76 million. Now, their estimated net worth was about $30 million, so the bill was more than double everything they actually owned. And the part that should scare every trust owner watching this was that it wasn't fraud. There was no scheme. It was an administrative paperwork error. They'd made trust distributions to people or entities outside the defined family group, which triggers family trust distribution tax at 47%. And then the interest charge on it started compounding 81 days after the breach and just kept compounding quietly for around 20 years, with the family having no idea it was building. By the time it surfaced, it had grown past what the entire business was worth. These people are effectively ruined over paperwork. It's terrible. That's why we do this stuff for every single trust client ourselves. The client never touches it. Some accountants leave it. Some business owners like to do it themselves. And I just tell them, this isn't the corner to cut. The documentation has to be done, and it has to be done before 30 June, not reconstructed afterwards. And if you want to be properly safe, there are 2 ATO guidelines you want to be sitting inside the green zone of. For professional services firms, there's PCG 2021/4, which is how you allocate the firm's profit between the individual practitioner and the rest of their family group. And you've got to run the estimates and the tests on all of that before 30 June. And for personal services businesses, there's PCG 2025/5, which deals with allocating income to the individual. Wages and director fees have to be booked before 30 June, dividends documented before 30 June, and trust resolutions resolved before 30 June. If you want to swim between the flags on both of these guidelines, all of that working has to be done before the end of the year ticks over, not after. Now, there's a reason my calm clients can do all of that without it being a scramble, and it comes back to structure. When the money is already sitting where it's supposed to be, there's nothing to reshuffle in June. Think about the difference. If your business runs through a company and the profit, it sits there taxed at 25%. And as long as you're not yanking it all out into your personal name at 47%, it stays put and there's nothing to scramble over. A family trust, on the other hand, has to distribute its profit every single year. And if that goes to individuals, it's at the top tax rate. And if it goes to a bucket company, the cash has to actually move there, which is hard when you're reinvesting everything back into the business. That's exactly the trap I see people stuck in. The structure itself is creating the June problem. I'm not going to go deep into structures in this video because I've covered it properly in another video. But the short version is that for most service businesses in the $1 to $10 million range, the company is just a better home for your profit. And the right structure is what turns end of financial year into a non-event. So if your end of financial year feels like a scramble every single year, that's worth paying attention to because it usually means something further upstream needs to change. Your rhythm through the year, your documentation, or your structure. It's not really a June fix. If you want us to look at your situation and tell you what a calm year would actually look like for you, you can book a call through the link below. And if you've got a trust and you're paying a spouse or family member through the business, watch this video I did on the ATO's income splitting crackdown next because it's the same theme as this one. And the paperwork and the structure are what the ATO is actually looking for.